Hello and welcome back to Market Shares. I'm your host, Tony Blodgett, and as you can see, I am down in Studio B. We paused our filming for the month of December, and we're back here to kick off the new year with a very exciting guest, and I think conversation that you're all really going to enjoy. Our new studio is being built. We moved offices, and so I'm excited to get back in there. But in the meantime, here we are, and luckily we have another place to record Market Shares. But you guys, today's guest, if you're in the mortgage space, probably needs no introduction. For those of you in real estate or other fans of Market Shares, you may not know this gentleman, but I want to introduce Dan Habib. He is the EVP, Executive Vice President of MBS Highway. He also runs another company. I don't know exactly his role there. He'll talk about that, but Crypto Charged. And so today we're going to talk a little bit about the mortgage market, some predictions for what might happen with interest rates in 2025, maybe a little bit about the housing market and what we're seeing there and what we think might happen with the housing market in 2025. I also have some questions about the impact of the election. I have some questions about Bitcoin, and I think Dan can help those. And I don't know, we might even talk about some drones because Dan lives up in New Jersey, so he might know what's going on with the drones that have been talking about all throughout December. So anyways, Dan Habib, welcome to Market Shares. Thank you for taking the time, brother.
Tony, always good to be with you, brother, and really an honor to be on your Market Shares podcast here. So looking forward to the conversation.
Awesome. Well, look, I think that, when people think of MBS Highway, they think of mortgage interest rates. What's going on with interest rates? Most of us, for all of my career, I met your dad. I didn't meet him personally, but saw him speak for the first time in 1997. Wow. When he was up on stage talking about the bond market and all that stuff. So I've been following Barry for 27 years, maybe close to 28 years, and have always what I've always appreciated about MBS Highway, about you and Barry, really is how you take what are complex things that are going on in the market around interest rates, and you present them in a way that's not only understandable for us loan officers and mortgage professionals, but package it in a way that we can actually then regurgitate that information to consumers and even makes it pretty palatable for consumers. So I love that aspect of what you guys do. Anyone can give you really complex ideas about what's going on, but if you can't understand them yourself and you can't relate them to reality, well, then they don't mean a whole lot, do they? And you guys do an awesome job of that. So look, I think it's here we're the first week of January here, and we had a Fed meeting a couple weeks ago, and as predicted, the Fed dropped interest rates by 25 basis points. We kind of thought that might be a good thing, but oh my gosh, Dan, soon after that happened, the bond market was, had a pretty negative reaction. But not only that, my crypto balances went down, my stock portfolio went down. I'm like, how can one man, Jerome Powell, have this impact where every single part of the market went down? Can you add any color to what happened and what this means for us as far as it relates to mortgage rates and how they're going to roll in 2025?
Yeah, it's a good question. And yeah, that Fed meeting was one that really kind of spoiled the party for a lot of the markets out there. So a lot of funny memes with Jerome Powell. But the bottom line is this was a cut. They did a 25 basis point cut at this meeting, but it was very much a hawkish cut, which is really what we expected. So a couple things to unpack here. First of all, there is an indirect relationship with mortgage rates and what the Fed does, but certainly not a direct one. A lot of people are under the assumption that the Fed is cutting mortgage rates, but in fact, they are cutting an ultra short-term rate. It's actually an overnight rate that banks use to lend to one another. It does directly impact certain short-term rates, like your money market accounts, your credit cards, car loans, things like that. But it does not directly impact long-term rates. And a lot of what impacts that is what the Fed's really posturing or projecting out there on inflation and the labor market. Those are going to be your main drivers of mortgage rates. But I think many people were taken by surprise that, hey, the Fed's cut 1% now this year, and we've seen mortgage rates go 1% higher, right? So the Fed, they were fully expected to cut 25 basis points at that December 18th meeting. And like I mentioned, that's 1% of cuts this year. Many people out there were criticizing the Fed because they're like, well, inflation has started to move up a little bit. And it really, not only has it not made progress the last few months, it's actually moved a little bit higher. And the labor market, back on the September 18th meeting, the Fed was concerned with it. That's why they led off with 50 basis points of cuts. We saw the unemployment rate moving higher, looked like there was a big concern there. And remember, the Fed has a dual mandate. So they want to see stable prices, which means they want to see inflation, or they want to see the prices of goods and services rising at 2% per year. And the other part of their mandate is that they want to see maximum employment, which means they don't want to see that unemployment rate go too high. So they look at both. And before, they were really concerned with the inflation one. But then inflation started to moderate and come down. They're pretty confident inflation is going to get to their 2% goal. But the labor market showed some weakness. And then that was their primary concern. If you look at their statement, now they believe that's balanced. In fact, reason why this was a hawkish 25 basis point cut really all has to do with their projections. So I want to just walk you through a couple slides just to show you what changed and why the market had such a negative impact. So when we look at their statement, right, there's many parts of the Fed meeting. There's the statement, and then this was one of those that had the SEP, or the Summary of Economic Projections. And then, of course, you have the Powell press conference. So the Fed funds rate, they cut by 25 basis points, and it's now in a range of 4.25% to 4.5%, which is 1% lower than it was before they started cutting on September 18th. And the effective Fed funds rate splits the difference. It's 4 3/8. And it was almost unanimous as far as the decision to cut rates, but there was one dissenter, and that's Cleveland Fed President Beth Hammack. And if you look at their statements, you have to look at like almost every word. They were very similar, but they changed some of the context to be slightly more hawkish when they're talking about doing additional adjustments to the Fed funds rate. And one thing I was hoping to hear was that they were going to announce when they may stop their asset runoff of their balance sheet, but there was no mention of it. And, just to kind of unpack that for a second, the Fed, they amassed a massive balance sheet from all of their QE efforts, quantitative easing, where they bought mortgage-backed securities, treasuries, but we're talking like $8-9 trillion they accumulated of these things. And when the Fed was doing all that buying, that absorbed a lot of that supply in the market. They were buying a ridiculous amount, and that kept rates artificially low to help us recover and keep borrowing costs low after COVID. And they also cut the Fed funds rate to zero, of course, for a while at that time. But then the Fed went on a path to normalize things because inflation got to 40-plus year highs. There was all this money in the system from $5.2 trillion in stimulus. So the Fed hiked up to 5.375% from zero. And then they started to reduce that balance sheet. So they were allowing these assets to roll off their balance sheet, but that floods the market with more supply. And they're allowing mortgage-backed securities and treasuries to fall off the balance sheet. But then earlier this year, I believe it was like at the May 1st meeting, they announced we're going to slow down the runoff, which means they're going to put a cap on how much of the assets are going to roll off their balance sheet every single month. And then anything above that cap, they actually reinvest those proceeds back into the Treasury market. But I am expecting, because of some liquidity concerns, and they have hinted towards this, that sometime in 2025, they're going to say, we are going to completely stop the balance sheet runoff, which that can actually be helpful for mortgage rates, because anything that's falling off their balance sheet, they're going to keep that balance sheet what's called net neutral, which means any assets maturing or falling off, or they receive principal payments, they're going to have to reinvest back into the Treasury market, which can absorb some of the supply out there. But bottom line is they didn't mention that at this meeting at all, but I do expect it sometime this year. But the big thing that the markets didn't like is something called their dots plot chart. So this is where the Fed members, all 19 of them, they anonymously plot on this chart where they think the Fed funds rate is going to be. And you could see here 2024, 2025, just 2 months ago and change, right? The September 18th Fed meeting. This is where all the Fed members thought the Fed funds rate was going to be in 2025. And the median projection was 100 basis points of cuts, or 1% of cuts in 2025. 2 months later, it changed pretty drastically. You can see now the median is 50 basis points, which means that the Fed in their projections removed 225 basis point rate cuts from this year. That is something the markets didn't like. I think that a lot of the markets were expecting the Fed to remove maybe one cut, but the fact that they removed two, I think it might have caught the markets a little bit by surprise. And if you look at their projections, they upgraded all aspects of the economy. So if we look at the unemployment rate, initially at that September 18th meeting, they thought the unemployment rate was going to get up to a level of 4.4% in 2024. They downgraded that to 4.2. In 2025, they thought it was going to remain around 4.4, and now they downgraded that to 4.3. So they think the labor market's going to be healthier. But one thing I like to do is look at where all the Fed members think the unemployment rate's going to be. Because while the Fed had a hawkish change here on their projections, it's not going to take a lot for them to flip-flop and change their mind. I mean, just look between these two Fed meetings, how much things changed. The Fed is very quick to change their tune based on the incoming data. If we start to see the unemployment rate go up, forget it. They're going to get way more aggressive on cutting rates, and they're going to be extremely concerned about that. So what might take the Fed by surprise? Well, that's where this chart helps you out. You can see that 14 Fed members do not think in 2025 that the unemployment rate is going to go above 4.3%. Well, right now, the unemployment rate's 4.2%, so it doesn't really give it a lot of room. And if you look at the other 5 Fed members, they don't see it going above 4.5%. So the majority don't see it going above 4.3, and all of them don't see it going above 4.5. So I think if you get an unemployment rate that's in the 4.4, 4.5, 4.6 range, forget it. These Fed members are going to be taken by surprise, and they're going to change their tune quickly. I actually wouldn't be surprised if this happens, because I think there's a lot of underlying weakness in the labor market, which we can get into. And the published data, I think, is kind of like a crock of baloney, to be quite honest with you. And I believe that that will come to fruition this year. We'll get the QCEW data, which shows you the actual job data for 2024. And it's going to show that about half of the jobs that the BLS said happened never actually occurred, because they have all kinds of issues where they're overstating job growth and then revising it lower. So I think that this is something that may play out, but now we at least know what might take the Fed by surprise. And then, of course, they upgraded GDP and inflation. They think inflation in 2025 on the headline PCE, not going to be 2.1 like they thought previously. It's going to be 2.5. And the core PCE, which is the most important, that's the one the Fed wants to see at 2%. Initially, they thought it was going to be 2.2%, getting close to that target this year. Well, now they think that's not going to happen. It's going to be 2.5%. And in fact, we might not get, based on their projections, to 2% until 2026 or maybe even 2027. So you put all that together, and that is why the bond market didn't like it, because of that hawkish switch. And the asset prices out there, like risk-on assets, like stocks, you look at crypto, they didn't like it either, because, listen, when you look at assets, there is a direct correlation to liquidity, right? Global liquidity and asset prices. If you just look at a global liquidity cycle and you look at stocks or you look at crypto, it lines up pretty amazingly, because, listen, when the Fed cuts, they are removing restriction from the economy. Borrowing rates on certain things are directly impacted and they're lower. It causes more liquidity out there, which always finds its way into assets. So that's a big part of the reason why. But also, I mean, listen, the stock market setting all-time high after all-time high, I think looking for an excuse to kind of correct a little bit, and the same thing with the crypto market. I mean, Bitcoin was up to 108,000, and since its breakout from its reaccumulation zone, really hasn't had any correction at all. It's been pretty straight up. It is so normal in a bull market to see not 10% corrections, like 30% corrections before moving higher. And I think both stocks and crypto were due. I mean, remember, they've been on this euphoric ride, thanks a lot in part because you have President-elect Trump, who is much more pro-business, going to deregulate. And of course, he's the first pro-Bitcoin, pro-crypto president. And he got rid of Gary Gensler, the SEC chair that was awful for crypto, and replaced him with somebody that's pro-crypto. And of course, he's talked about starting a strategic Bitcoin reserve where potentially you could have in Q1, I mean, you could have the United States buying 1 million Bitcoin and sitting on it for 20 years. That's like 5% of the entire supply of Bitcoin. I mean, could you imagine how bullish that would be for the crypto markets?
Yeah, well, I'm looking forward to talking a little bit more about Bitcoin. I just want to stay on the Fed thing for a second, because I agree with you in that it wouldn't take much for the Fed to change their tune quickly. I feel like they came out of the gates. What was that? Whatever the pivot meeting was. I don't know if it was September or the one before that.
September 18th.
Yeah, and everyone got super excited, and they were talking about all these cuts, and it was almost like this exuberance, like, was quick to build up about how exciting it was going to be and how much the Fed were going to cut and so on and so forth, and it's almost like they're trying to walk that back a little bit, like a little bit of a wet blanket on it, like to chill things down a little bit. But to your point, all it takes is these unemployment numbers to come out different. It takes, a couple misses or some lower numbers on the PCE, and all of a sudden, I think they would change their tune pretty quickly. They just don't want people to be too optimistic. But for those of us in the mortgage business, it was like a freaking dagger in the heart, when we saw what happened with the market. We saw the quarter, and we had a 50 basis point sell off, after that in
that day alone.
Price. Yeah, that day alone. And so, I think that what we need to remember, because, most people watching this are in the mortgage business, is, we can't think about our business over the next 12 months in 2025 dependent on what interest rates are going to do. But I also wouldn't be so downtrodden that there's not going to be lower rates simply because of this December meeting. We got to watch the data. And if the data changes, which there's lots of reasons to believe that it might, on the things that Dan mentioned, this could turn around pretty quickly, So
I agree with you, Tony. I think the two biggest things to watch for is what happens with inflation in the labor market. And listen, inflation, it was doing really well. Really the whole fourth quarter, it completely stalled and moved in the wrong direction. There was some mechanical things happening there, though, right? So when you look at these inflation reports, every month you get a new reading. And for simplistic terms here, if you add up the last 12 months, that's how you get like your year-over-year number. But when we get an inflation report, that same month from the previous year, it falls off of the annual calculation, and it is replaced in that calculation with the new monthly reading. So the numbers that are being replaced have significance, because just think about it logically. If you're replacing a big number from last year, well, the probability that you're going to replace it with a smaller number is higher. And if you do, then that means that it's easier to make progress on year-over-year inflation. But the opposite's also true, and that was precisely the problem in the fourth quarter that we had. We were replacing numbers that were less than 1/10. So if you get a number that's like 2/10, which annualized, that's not bad. That's 2.4% core inflation. It still causes inflation to go up because you're replacing such low figures. So there was some of that happening. But in addition to that, inflation is being overstated. Now, listen, I want to explain something, because I'm sure a lot of listeners are like, I hear you talking about inflation coming down. You're full of it because prices haven't come down at all. And you're right, they haven't. But you have to remember what we're talking about here. The Fed's goal in their perfect world, they want to see prices rise at 2% a year. But that means things are still getting more expensive. Unless you see, and you don't usually see this happen unless you have like a recession or something, but unless you see negative inflation, you see deflation, then you don't see an aggregate prices coming down. When we say inflation's gotten better, we mean that it's decelerated. So the rate at which the price of goods and services is going up has gotten a lot better and come down a lot from where it was, but prices are still going up, make no doubt about it. And then if you look at a chart that I have a chart that actually I think really expresses this pretty clearly here, where it just shows you the impact of inflation, where it's like this red line is your rate of change, right? So this is your year-over-year change in inflation. Notice it was all the way up here, 40-plus year highs. It's come down. So the rate at which prices are going up has cooled off. But if you look at the blue line, that's the index. So that shows you prices. Notice how they just go up and to the right.
It's never going to go down, right? I mean,
look, there's a couple times in recessions that you could see it go down a little bit, right? Like the Great Recession, COVID prices went down a bit. You saw some deflation. But by and large, it's always going up and to the right, but there's periods of time where it goes up more aggressively or when it goes up slower, and the Fed wants to just see it go up slower. So listen, the mechanics didn't help us with inflation, but the other thing that didn't help us is it's being overstated still, in my opinion. You have to remember that there's many different components of these inflation reports, but by far the largest one is a component called shelter. In the CPI report, it makes up 46% of core CPI. And in the PCE report, personal consumption expenditures, which is the Fed's favorite one, it makes up 18%. But shelter is not what you think. It's not home prices. A lot of people make that mistake. They are looking at rental costs and then something called owner's equivalent rent. So how much are rents going up, blended rents, new rents and renewal rents, and then not how much home prices are going up. It's actually a pretty ridiculous thing that they do. What they do is they call homeowners and they ask them, how much could you rent your home for? Now, I don't know about you, Tony, but
very scientific.
I'm in the business, man, and I don't know how much my personal home would rent for in the going market. I don't, right? So how does an average consumer know that? But the bottom line is this. It tracks very closely with how much rents are going up. So getting to my point here, within the inflation reports that we get, the biggest component, shelter, they're saying it's going up 5% a year. But if you look at much better representations of what's really happening in the real world, like CoreLogic's blended rent index, it's only going up 1.7%, right? So you literally have like a little more than a 3% overstatement. And if you just do some calculations for the CPI, that means that inflation is being overstated by well over 1%. In fact, instead of it being 3.3% year over year in the core for CPI, it would be 1.9% if shelter was caught up. PCE, it's a similar story. Instead of being 2.9%, it would be like 2.2 or 2.3, much closer to the Fed's target. Doesn't have as big of an impact as the weighting's a little bit less on that one, but still significant. So why is this not reflecting what's happening in the real world? It operates on a ridiculous lag. It takes a long time for those new rents and things to filter through. I mean, we are going on like a 15-month lag here, and it's something that is frustrating. And the Fed has acknowledged this. They have said, you know, we have shelter rents that are shelter that costs that are going to catch up eventually because they too know it's overstating it, but it's somewhat frustrating. So that is a big thing to watch out for. And the other thing is, and I think we will see the replacements in the beginning of the year, you know, they get a lot beefier. So I think the next few months, it's going to be a lot easier to make progress on inflation, and shelter is starting to catch up, starting to see it in the numbers a bit. So I think you could see inflation do a little better than some people thought. And the labor market, I think, is going to do a lot worse than some people thought. And there's a few reasons for that, because number one, you know, the BLS, the Bureau of Labor Statistics, they probably piss you off because you guys know every time in 2024 when a jobs report came out, what happened? The bond market sold off and rates got worse because there was a blockbuster jobs report, right? Much stronger than estimates. And then what happened every single time? Market reacts negatively, but then over the next 2 months, they revise the numbers down by like 100,000, and it completely changes the report, but now it's after the fact. And it's very frustrating because if they would have had their act together and got it right the first time, mortgage rates would have came down. But instead, they went up, and then they don't really react as much to the revisions because it's old news. And that is just their revisions. Get this. So you have the jobs reports released, and then in the 2 subsequent months after, the BLS revises those numbers on their own. And then much later, the BLS, the same organization, they release something called the QCEW, or the Quarterly Census of Employment and Wages. And what this gives you is the actual data. You see, what the BLS is doing is every month trying to give you a monthly estimate. And listen, don't get me wrong, it's a Herculean task. But what they're doing is sampling 670,000 businesses, large businesses, and seeing what's going on with jobs. They're also using some models like the birth-death model, which is completely skewing the numbers. It's trying to assume how many businesses came online and offline, and based on the sector it's in and what we've seen over the last 5 years, how many job gains or losses that accounts for. I wonder, did something happen over the last 5 years that could be skewing those seasonal adjustments, right?
No.
Of course. right? So, but that's what they're doing there on that. But the QCEW covers 12 million establishments. It's the actual data, covers literally more than 95% of all the jobs in the US, and that's the actual numbers. Well, we're going to be getting next month in February the final data for what happened in 2024. But we already got the preliminary data, which the market doesn't really react to, but it will in February. And it showed that if you look to 2024, the BLS said we created 2.5 million jobs. The QCEW estimate says that we only created like 1.246. So
wow.
the BLS, literally, half the jobs that they said were created didn't happen. And that's according to the preliminary estimates. It could even be worse than that. And what it really means is that the BLS, even after their own revisions, they overstated job growth on average by 100,000 jobs, which would materially change every single one of those jobs reports. I think that's something to keep an eye on, because that's something the markets could react to. That's something the Fed could react to, because remember, they're making all these decisions, based on the labor market being really strong. Well, that certainly doesn't look that strong then, and maybe we're in a worse position. So those are some of the big things to watch out for, because make no mistake about it, the two biggest influences, in my opinion, for mortgage rates this year are going to be inflation and the labor market, and of course the Fed. And we have to see what happens too with the Trump administration too, because as you had mentioned earlier on, there's been a lot of fears out there that Trump could be inflationary because of his tariffs. The bond market has certainly voiced how they feel about it as well.
Right. Well, and you mentioned that being kind of like a revision or in February. Sometimes these revisions just kind of get glossed over, and it's like, had the headline number been what it should have been, we would have seen an impact in the market. But because it's done through a revision, maybe not as impactful. Is this report that comes out in February going to be a little bit more impactful if in fact it does show that they were off by, 50% of, or double their projections?
I think two things are going to happen. Listen, I think we're going to see the jobs reports that are coming out this year. Then we're going to see them be a little bit more maybe indicative of what's really happening in the labor market. I'll give you and I also think that those revisions from last year are going to have a material impact. But the jobs data, I mean, listen, I don't want to sound like a conspiracy theorist here or anything, right? But it doesn't add up, right? There's something called seasonal adjustments that make a lot of sense to do, meaning, hey, we want to seasonally adjust out of the jobs numbers effects that happen every single year at the same times, because we want to really know, is the labor market weak or strong? And if you don't do something like that, well, then in the fourth quarter of the year, what happens? All kinds of companies, they do seasonal hiring for the holidays. And if you don't seasonally adjust that out and move the numbers down, all of a sudden it looks like the labor market's on fire. But it's not in fact on fire. It's a temporary phenomenon that happens every year. So normally what occurs, you seasonally adjust those numbers down by a significant amount so you can see, is the labor market really growing or not? And then in January, after the holidays, you seasonally adjust those numbers up, because of course there's going to be a ton of layoffs from those temporary seasonal hires, but it doesn't mean like the labor market all of a sudden fell apart. It happens every year. So the purpose and usage of a seasonal adjustment makes a hell of a lot of sense, because otherwise the jobs data would look like an EKG and you wouldn't know what the heck is up or down, right? But we saw unusual things happen this year. Now, listen, some people out there will tell you that the timing is a little suspicious, going into an election and things of that nature. Who knows? I can't tell you, right? But what I can tell you is that it was the most generous seasonal adjustments that we've seen factually in 50 years, 49 years to be exact. And there were months where you normally seasonally adjust those numbers down and they seasonally adjusted them up, which makes absolutely no sense to me. Of course, we talked about the reliability of the reports as well, but I do think that, those seasonal adjustments are supposed to cancel out throughout the year. I think the labor market is weaker than the published data would show you out there. If you look at things like continuing claims, meaning people that are continuing to receive benefits after they're laid off, that has risen to the highest level since 2021, which shows you that there's less hiring. Once you're laid off, it's harder to find a job. If you look at job openings, they've come down considerably. And I think those are overstated too. You can't really compare that historically anymore because after COVID, what happened? You have work from anywhere. You have companies posting job listings in every single state because they could hire somebody from anywhere, but they all get counted. But it's one job, not 50, right? So it's hard to quantify the impact of that. But there's a lot of measures of the labor market that are showing weakness. The BLS not adding up. I think the other part of it is most people don't realize that the jobs report has two reports within one. One of them is called the business survey. That's where you get the headline job creation number. And then the unemployment rate, it doesn't come from that report. It comes from something called the household survey within that same jobs report. So when you're looking at like the headline job creation number, 250,000, that has absolutely nothing to do with the unemployment rate. The household survey, instead of sampling 670,000 businesses, it's called the household survey because they phone call about 60,000 households and they ask them a series of questions. I think that's flawed too, though, when it's understating the unemployment rate. And I'll give you an example of why. So, Tony, imagine I am the BLS. I call you and I say, Tony, are you employed? You say no. That doesn't automatically qualify you to say, okay, this person's unemployed. No. They then say, okay, you're unemployed. Have you looked for a job over the last 4 weeks? If you say no, they remove you from the unemployed and they remove you from the labor force. It's as if you don't exist because you're not actively looking for work. So they don't count you in the numbers, but you are still breathing and you are still unemployed. But believe it or not, that is how it works. You're considered a disgruntled worker or and you are not counted. Now, let's say if you say, yes, I have looked for a job the last 4 weeks, right? Well, that doesn't automatically count you as unemployed either, because then what they say is, have you done any interviewed or filed any job applications? If you say no, they don't count you because you have to be actively looking. And to be actively looking, you have to have looked for a job in the last 4 weeks and either filed an application or done an interview. This is right on their website, right? As far as their methodology goes. So it's not as easy as you think to be counted. And as such, if you look at the household survey, it shows a lot weaker of job creation numbers, but the unemployment rate's not going up because the labor force keeps getting reduced because they are not counting people. Now, there is another measure of unemployment called the U6. The one that everybody talks about is the U3, right? That's the one that's 4.2%. The U6 adds back all those people that they remove or delete. And wouldn't you know it, it's not 4.2, it's 7.8%. It's much higher, but that truly is more indicative of like the real unemployment rate. But for whatever reason, people don't go by that one. They go by the U3. But I think you're going to see the unemployment rate begin to move higher. I think some of these games that are being played are going to stop. And I think in February, you're going to see some really big revisions to 2024 where, like I said, about half the jobs that thought happened didn't happen. And I think you will see a market reaction there. I think the Fed won't be able to ignore that. And listen, my prediction is even though the Fed at the last meeting on December 18th, they took away 2 rate cuts and they said, we're not going to cut 1%, we're going to cut 0.5%. I wouldn't be surprised if the Fed ends up having to cut 1% and flip-flop backs because inflation, I think, is going to moderate and because I think the labor market's going to show weakness.
Yeah, I totally agree. I think that there's a lot of unknowns about what's going to be the impact of some of these decisions that the administration at least says that they're going to implement, and I think time's going to tell, and they want to kind of hedge their bets there. Let me. We only got about 10 minutes left, Dan, and I want to rapid fire on a couple questions.
Yeah.
Let's just stay on that. So a lot of people think about the election, and they say that the stuff that Trump has proposed is going to be inflationary. There's really 2 things, though, that I see that could potentially bring down inflation. The first one is DOGE, right? This effort to drastically reduce the size of the federal government. And if they're successful in doing that, and you just got to look at Elon Musk and what he did with Twitter. Like, that was like 70% of the people were gone.
There was a lot of fat there.
There's a lot of fat. Now, they probably don't get rid of 50 or 70% of the U.S. government. Maybe they do. Who knows, right? That's the thing. We don't know. But my point being is that if they're successful in drastically reducing that, I would think that could be, that would help bring down inflation because a lot less money being spent there on things like that. It would definitely have an impact on the employment numbers too, because now you got some unemployed people as a result of those decisions, right?
Make no mistake about it. The ridiculous and irresponsible government spending creates a lot of economic activity. And I think we probably would have seen a recession if not for the ridiculous spending that we've seen. I think if Elon Musk and Vivek are able to successfully do that, that's yet to be seen. I think it'd be fantastic. I mean, listen, this is a ticking time bomb. 36 trillion in debt, and it just keeps getting worse. We just keep spending like crazy. We do these stupid, let's keep the government open meetings and agreements and just kick the can down the road and raise the debt. So here's the problem. Nobody's going to get elected on a let's have a great reset, right? That's not going to be a winning ticket, but there has to be something done. I mean, it can't go on forever, but it certainly all the government spending causes more inflation. And also, when we have to come up with money for this stuff, what do? Like when we go into debt, what happens in reality is we issue treasuries, which then have to be sold, and there's more supply of bonds or treasuries on the market, which doesn't help mortgage rates.
100%. So the other thing that I've talked about it on this podcast a couple times is oil prices. One of the things that Trump also led with was, drill, baby, drill, really bring down the cost of oil. I mean, if he's successful in doing that, despite the, economic growth that he's proposing, despite the impact of tariffs, whether those get implemented or not, I would think that if he's successful at driving down the price of oil, as he said that he's going to do, I mean, I've looked at many charts. You probably don't have one fired up and ready, but you know what I'm talking about. When oil prices go down, mortgage rates get better. I mean, there's just no question about it. There's like a direct correlation, it looks like to me.
It's here's the thing, right? It's the single biggest influence on inflation. Now, listen, people, they're like, oh, well, the Fed looks at core inflation, which strips out food and energy. Oil prices find their way into everything. Any good that's created or shipped, inflation is impacted there by oil prices, right? So if oil prices come down, you're going to have inflation come down. And, part of the reason why the Fed looks at the core is because inflation can be so heavily impacted by oil prices that the Fed doesn't know if their monetary policy is making the change or something else, right? But I think that's huge. The other thing that you didn't mention there is deregulation. And the tariffs, I mean, listen, those could be bargaining chips. We are getting taken advantage of by all the trade partners out there. And it's kind of ridiculous. And, I know a lot of people don't like the idea of the tariffs, but I think Trump's, thought process of putting America first and trying to bring things back here and not being taken advantage of by these other countries out there is a good stance. But you don't win a negotiation by saying, we're not really going to do that. I mean, you got to really make them think that you're going to do something, right? Otherwise, you have zero leverage. So I think some tariffs may get imposed, but maybe our trade partners come to the table and they stop shipping over, these, drugs that are killing our citizens here and things of that nature, right? I mean, it's not like Trump's asking for like ridiculous things, but also all we have to go off of is his first term where he imposed tariffs. They worked so well that the Biden administration left them, and inflation came down to 1.9% because of his things with oil, because of the deregulation. So listen, it's yet to be seen, but unfortunately the bond market has spoken, and there was definitely for a while a bond market trade where they thought inflation was going to be higher because of the tariff potential, because of the narrative that people are putting out there with it.
Well, and look, I think despite your political opinions, he is the president-elect. He's talked about doing all these things on the campaign trail, and since he's been elected, we know he's going to be, inaugurated and on January 20th. So I think that, these things may sound like they're political in nature in this discussion. It's really not. It's like,
this is the president coming in.
It's predicting. This is what he said he's going to do. What do we think the impact of those decisions are going to be if he's able to implement them as presented? I personally think inflation comes down because I do think that he'll be successful at driving down the price of oil, only because he's done it before and he made it very clear how important that was to his overall economic agenda. And if that happens, man, that is what gives me the most optimism about lower interest rates. I'm not as worried about the tariffs. I'm not as worried about the growth of the economy, creating more inflation. I think, no pun intended, oil prices trumps it all. if you can get that down. All right, so really quick, and I could go on for another hour with you. I got so many things I'd like to touch on, Dan, so maybe we can do another episode at some point. I want to just touch on Bitcoin really quick, because Bitcoin has gone crazy. It's up over 100,000, like you said, peaked at about 108,000 per Bitcoin. I was watching one of your podcasts from only about a year ago, and it was around 15,000. And you said, well, look, it could go a little lower, it could go to 11, but I think it's going to go over 100,000 in the next 2 years. I wish I watched that. I wish I watched that episode a year ago, because I would have dumped a bunch of money into it. But look, here's the question. I look at people like Michael Saylor, and these guys out there, and a MicroStrategy CEO, right? And I've heard things, and we got to be quick. We're almost out of time.
Yeah.
But a $13 million Bitcoin in the next 20 years, like, is that even like what is? Any credibility
I
to
think
that?
I've seen estimates all over, but a lot of them. If you look at like Kathy Wood, ARK Invest, they're like base cases. It's going to be at least $1 million a coin, right? So that would be 10 times higher in the year. But I think that is potentially possible, right? So Bitcoin, nobody thought it would get here. But if you just look at the mechanics of it, it is a supply and demand story. It's pretty simple to understand once you get past the digital currency aspect of it, right? So Bitcoin, everybody was surprised it was going up in 2024 after the halving. I've been trying to preach to people like it's a pretty easy pattern to see. Please invest something and get some exposure, because it's going to go up. It can't not go up, because every 4 years, what happens is the supply of Bitcoin coming to market gets cut in half. Most people are like, in the housing industry, right, on this call. Imagine if builders every 4 years said, I'm going to build half the amount of homes I built 4 years ago. And that keeps happening until there's no more supply left. What's going to happen with home values? Well, you're going to continue to have more demand and less supply and less supply and less supply, and it's going to drive the price higher. That is precisely what happens with Bitcoin. Bitcoin is the scarcest asset we've ever seen, meaning there is a finite amount of 21 million that can ever be created, and we're almost at like 20 million right now created. Okay, so it is literally almost done, and you are going to see the supply coming to market, which right now it's 450 a day. When it started, it was 7,200 a day. And then in 3 years from now, it's going to go down to 225 a day. And that's going to keep happening until about the year 2150, where the last Bitcoin is going to be mined. But over the next few years, for all intents and purposes, all of the Bitcoin is going to be mined, right? So then you have the pro-crypto stances from the president, from the SEC chair. But it's gone mainstream too. You don't have to go to Coinbase or an exchange to buy it anymore. Now there's spot ETFs or exchange traded funds. So your traditional investor can tell their advisor, hey, give me 5% exposure to Bitcoin, and they could buy it like a stock. So all of these things are occurring, but it's very much a supply and demand story. I think this year, this cycle, I have predictions where I think Bitcoin is going to get up to like 150,000. But I certainly over the next few years could see it going to several 100,000 per coin because of the supply and demand story. And then, boy, imagine if the U.S. builds a stockpile of 1 million Bitcoin, what that's going to do to the price. But now you're seeing companies adopt it as a treasury asset. How do all these people with these crazy predictions end up coming up with 1 million or more as a price target for Bitcoin? Well, they are forecasting out the market cap of it growing to that of, let's say, a gold. And what they're doing is they're saying, okay, in order to get there, you need to have a lot of the publicly traded companies that instead of having cash on their balance sheet, they adopt Bitcoin. We're starting to see that happen. And if you get more regulation that's pro-crypto friendly regulation, it makes it easier for institutions to invest. You got BlackRock behind the most successful most successful ETF in history. Okay, so all the players are there now, and I don't see a way how it's not going to be several $100,000 per coin over the next, let's say, 5 years. But I wouldn't. That would be the most conviction I would have in any prediction. Let's put it that way.
Well, no, look, I think we could probably do a whole episode on crypto. Maybe you'll come back and we can talk deeper about
Tony. You know what?
Crypto.
I know we don't have that much time. Let me just give this one nugget here, okay? So I think the real estate market is, right now you're seeing people talking about a housing bubble again. First of all, you should prepare yourself. The monthly appreciation numbers, they're seasonal, right? So like, the numbers lag a few months, right? So we're starting to get numbers from the end of the year as far as like Case-Shiller, FHFA. They're probably going to be slightly negative, but that happens every year in the slower part of the season. And then the beginning of the year into the spring home buying season in summer, you see stronger appreciation numbers. So you're probably going to have the Diana Olics of the world saying housing bubble, housing bubble. But the bottom line is this. If rates came down, sure, that would help things. I do think rates are going to come down over the next 6 months. I think there's a chance we could see them come back down to 6% or maybe 5 7/8 if we get a little lucky with some of those things with inflation and the labor market. Okay, but the housing market, supply and demand wise, inventory is still very tight. Builders, we have good visibility into their permits, their starts, and you don't blink your eyes and a home's created. So the starts, there's only around like, I don't know, 1.4 million starts or so. And if you look at household formations, I just got some updated annualized figures, it's 1.9 million. So that's your demand component versus the supply coming to market. It's still very, very imbalanced, which is going to be supportive of home prices. And I think something else that actually the last two things we talked about, I have been doing a lot of research on this where crypto, I think, could be an influencer on home values. And the reason why, and you guys might find this interesting, is the amount of wealth created to this point is like, I don't know, just over since the beginning of 2024, it's like 2 trillion. Over the last like 60 days, it's like 1.5 trillion or something, right? Enormous amount of wealth. I think that by like August this year, that's going to go much, much, much higher. And there were studies done by places like Pew Research where people with crypto gains are 2 times more likely than any other asset class to spend their gains. Well, why is that? Probably because the majority of people that own it are more heavily weighted towards the younger age groups. So those individuals, by the way, the segment of the population that owns the most crypto, their home ownership rate's like 8%. And then the next biggest group is like millennials, and it's, median age is like 38 now of a first-time home buyer. So I think there is such an enormous opportunity for people that have created this enormous amount of wealth in a short period of time to trade in their digital assets for more concrete assets like real estate, right? Tangible is the word I was looking for. And it makes a lot of sense too, because most of them don't own homes. And that is why Pew Research said in their study, they said they have found that counties with a higher concentration of people that own crypto is directly linked to higher real estate values. So I thought that was an interesting tidbit. And I think that that's an X factor for this year that could influence home prices higher.
Well, it's probably going to help the exotic car market too, right? I mean, let's just be honest.
Yeah, for sure.
So those same young people are buying Lambos too. But no, it makes a lot of sense. I mean, these guys don't own a house. 8% of them own a home. And even if you have modest gains in your crypto, right? Doesn't have to be massive wealth, but you get 20, 30, 40, 50, 80 grand of profit that you can cash in. And now you got a pretty decent down payment,
yeah,
on a first-time home. I mean, man, you're in really good shape, and you don't even need that much. So, they do have a more propensity to be invested in crypto and maybe leave their money there. A lot of crypto investors leave their money there, but a lot, are very speculative. Those are all things that I would love to dissect with you in an episode, perhaps, where we talk just about crypto and your thoughts around that, because we didn't even get a chance to get into crypto charge today. I don't know much about that business that you have, but I want to learn more, and maybe we do an episode about that if you were down to
Sounds
come back
good, man.
and do that. All right,
Time
man.
went fast. Time went fast, brother. But
it did go fast. And our technical difficulties at the beginning, different studio, cost us a little bit of time. But I didn't put a pin on it as far as what do we think rates are going to be. Like, we had to predict it. I'm not even going to know that I'm going to predict a rate here in 2025. What I predict in 2025 as far as rates is more of the same until we see something different in the numbers, right? I mean,
yeah.
Do you have to wrap it up, would you say anything else?
Optimistically, I think we could see rates come back down to where they were in September. I think you could see the 10-year come down to like a level of like 360. And if you then extrapolate what that means for mortgage rates with normal spreads and where spreads are, I think they narrow a little bit more. I think you could see mortgage rates, around 5 7/8 or 6%. I think that there's a possibility of that happening potentially over the next 6 months. But as you mentioned, a lot of it's going to depend on what happens with inflation and President Trump. What happens with the labor market? Do we see some of that weakness that I was highlighting? Do we see shelter catch up? All of these things are going to play a role. What does the Fed then do in reaction? What happens with these job revision numbers from the QCW? But I certainly think that there's a path to that occurring.
Yeah. Well, let's all hope for 5 7/8. Dan said it here. No. Look, it's very data dependent. I sound like Jerome Powell now. It's very data dependent what we're going to do. Well, hey, Dan, I appreciate you taking the time today. And this is a great conversation. You brought a lot of knowledge here to the table. I hope we can do this again at some point, maybe heavy on the crypto conversation, because I think that's so interesting. There's so much I don't know about that space. And I know enough to be dangerous. I've been learning more. I do have a Coinbase wallet. I want to talk to you about that too. Like, where should I keep all this stuff? Anyway, that's a whole other conversation.
You should keep it in a ledger.
Yes.
Anybody that owns crypto, listen, Coinbase is U.S. publicly traded, but I am a believer that you shouldn't leave your crypto on the exchange, because you are susceptible to third-party counter risk, which is why people got screwed with FTX and these overseas exchanges. There's the ability to take self-custody if you're buying the actual coins, not like the spot ETFs. And why not do that? So I personally buy all my coins on Coinbase, and then what I do is I transfer I take them out of the exchange, and basically you leave them in the blockchain that you then have access to it from your ledger device or your 24-word passphrase. So you obviously can't lose those things, otherwise you'll never be able to access your crypto. I'm sure you've heard some nightmare stories like that. But then there's no risk. Like, no, I can't lose my coins. I can go anywhere in the world and I can pull it up with 24 words or with I use the Ledger Stacks, which is really cool. It's the new one that's touchscreen. It's kind of like that, kind of like almost like a Kindle or something kind of thing. It's small though. And that's how you could sign your transactions and quickly send my coins from my wallet to an exchange, which is a place where you can buy and sell. So that's the way I would recommend doing it. It's the safest way to do it. Anybody that's like a real crypto person will tell you if it's not your keys, it's not your coins. So,
but if you're taking your money out of Coinbase and into a ledger, are you paying those withdrawal fees and transfer fees and all that stuff to do that?
I mean, listen, it's very minimal most of the time. Okay. We're talking about very, very small. It depends which asset you're sending. It depends what the specific network looks like at the time. But I mean, talking about if I'm sending $1 million of Bitcoin and it's charging me a couple dollars, I'm not really that concerned.
Got it. It's not like buying the asset with US dollars and buying Bitcoin where they charge you like
no. Those are exchange fees. Like if you do a market order, they hit you with a big fee there, right? Because you are asking for the lowest price instantaneously. That's a market order. But if you actually want to pay less in fees, do a limit order, which means that you say what price you want to buy it. So instead of taking liquidity off the market with a market order, you're actually providing liquidity on there, and you pay less of a fee. And also it guarantees the price so long as the price gets there that you get executed at. One of the things people don't realize is like certain exchanges, especially, they're not that it's getting better, but there's certain exchanges that maybe it's not as liquid as you think. And then you might, if you're putting a big order in and you say like, let me get 10 Bitcoin, it might show you the price on the screen to pick a number is like 100,000. But in order to fill your order, you can get a ton of slippage, which means it goes up the order book, right? So the lowest, but you could have a significant difference in the price you get executed at, because of not enough to fill your order at that price. So if you do a limit order, that prevents that, and you pay less in fees. It's just a little tidbit there. But.
All right. Well, like I said, probably lots to unpack in the crypto space. Dan, I want to thank you for your time today. For those of you watching, I want to thank you for your time and attention. I'm excited for 2025. This is going to be a great year. We're going to have some great episodes. And Dan, I appreciate you kicking off the year for us. And until next time, everyone, take care. Thanks, Dan. I'll talk to you soon.